So Diamond Chemical calculated their capital expenditure using earning per share, payback period, discounted cash flow and internal rate of return (IRR). So their EPS is $0.018. Their payback period is 3.6 years. Net present value is 9.0 million. And lastly, their IRR is 25.9%.
Capital expenditures are payments for goods or services that are recorded or invested on the balance sheet of the company rather than incur on the income statement. Expenses are required for businesses to maintain existing property and equipment, as well as to invest in new technology and other assets for expansion. So how do we calculate capital expenditure? We can use the amount we calculated for the company's capital expenditure to help with our financial planning. This is due to the fact that our company's capital expenditure will allow us to see how much money is invested in new or existing fixed assets. Not only that, but knowing how much we spend on fixed assets in the previous period can help guide our decisions. When we invest in assets, we should ideally make a lot of money for our company. It is also reasonable to select assets with a long lifespan. As a result, we must effectively make decisions and perform careful and accurate capital expenditure calculation.
Based on my research, as a result, I enable to commend the merit of their suggestion. Diamond Chemical plc would benefit from weighing the merits of each suggestion against the company's strategic goals and financial consideration when evaluating all suggestions from the various divisions. The potential impact on communities and the environment, as well as compliance with legal and regulatory requirements, must also be taken into consideration. In general, it's a good idea for any business to take into account suggestions from all of its divisions because they may bring fresh ideas and perspectives that will help business.
So for this question, what is the director of sales suggestion and does it have any merit? The director of sales suggestion is the company have to shift the capacity away from Rotterdam toward Merseyside in order to move the added volume. And in my opinion, the suggestion of the director of sales is merit. This is due to it will help the company lower the cost of reduction project, and at the same time they will getting more customer, and as we can see it will maintain the cost of competitiveness.
Why did the assistant plan manager offer his suggested change? That it has any merit? Yes, it is because of the concern that include the renovation of the EPC production line as a part of polypropylene line based on the argument that it would give BC the lowest cost base and improve cash flow by $25,000 indefinitely. It is because the EPC had only been marginal profitable due to the entry of competitors and the introduction of other competing materials. In last 20 years, no more from corporate has been monitored renovation projects once the investment decision was made. In ethical dilemma, executive bonuses back to performances of individuals division.
The analysis from the Treasury that 10% hurdle rate includes inflation and the existing calculations continued using it as discounted rate. It is a wrong approach. So, the estimates long-term inflation rate as 3% as given in the text. And the right approach will be to use real discounted rate 10 minus 3 become plus 7% in calculating the NPV.
Okay, first, inflation must be considered because it influences cash flow and discount rate. The implication that the DFC analysis must be based on discounted real income rather than normal income. As a result, Greystock DFC analysis must be modified to be based on consistent cash flow and discount rate using a discounted price rather than nominal target rate of return. After that, grey stock DFC analysis should be revised to account for the effect of cannibalization on the company. For example, there's a good chance that the process will have a short-term impact on the company performance by reducing sales and current production at time when companies are facing stiff competition. Grey stock must consider how any fees will affect the utilization of extra rolling stock. In addition, adjustments to DFC are required because grey stock includes some costs that provide misleading insight and projection.
Assalamualaikum and good evening to Dr. Ameh and my fellow friends. So I will present my part, which is the question is what is the Merseyside project worth to Diamond Chemicals. So in my opinion, one of the benefits that Merseyside project to Diamond Chemical is it can increase the manufacturing by 7%, and it also can improve the gross profit margin from 11.5% to 12.5%. And in terms of energy saving, it is expected to increase by 1.25% of total sales for 5 years, and for the next 6 to 10 years it can increase respectively 0.75%. And to sum up, all the revenues will be shown in the income revenue statement for the company. So that's all from me. Thank you.